Hey everybody, my name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech investing for a broad audience of retail and institutional investors across the globe. Today we're going to talk about why Gingko Bioworks stock soared, and that's a bit of a clickbait title. The stock was up around 22% yesterday, and that coincided with the release of their 10K, so we can only assume that both of those events are related. Now, we've covered Ginkgo quite a bit in the past because there's a lot of reader interest. It's an exciting company. We all know the value proposition. So what we're going to focus on today are looking at things that were revealed in the 10K of interest to investors and to people looking at possibly investing in the company. So first of all, revenues, these came in very healthy. On the left-hand side here, you can see revenues broken down by type. So biosecurity came in at around 201 million. That's a significant amount of money that contributes to overall revenues. We have Foundry related and also Foundry. So we want to always separate the Foundry related from third parties because of reasons we've talked about before. So we've done that on the right-hand side here and removed biosecurity. So we're not interested in the biosecurity exposure we're getting. That's expected to decrease next year when Ginkgo estimates 160 million in biosecurity revenue. So we've broken out the Foundry, which represents about just under 60% of total Foundry revenues are from third parties, and then 41% from related. That's about the same number as last year. What's important to look at is the ratio of related party revenue to third party, and you can see here that third party is growing very fast and that related party is dropping, so that's good. In regards to biosecurity, that was a big chunk for this year. As we said before, they're expecting less next year, but what's most important is they're breaking that out into a separate revenue segment so that we can clearly distinguish between Foundry and biosecurity. Now, when looking at their deck that came out, so they had a call, which had some interesting tidbits, a deck, and then, of course, the 10K. We looked through all of them. Regards to royalties, the 10K says for the years ended this year and last year, say 2021 and 2020, royalties didn't comprise a material amount of revenue. The exception there would be the milestone payments made by Kronos Group. So they paid 12 million in Q3 of 2021 and 12 million in Q4 2021. Now we've pulled off of the Gingko Bioworks annual results deck this bit of information which surrounds some completed projects of theirs that are expected to bring in royalties. So the oldest, or the ones that were completed the longest time ago, would be this chemicals project with a confidential customer and these consumer food projects, flavorings that they're working on. So in the annual results call that they had, the company said that there was royalty revenue baked into their 2022 guidance for Foundry revenue. So we'll look forward to seeing, hopefully, that we can get some color on where that's coming from. But for the company to receive royalties, that's a key milestone because then we can see that the entire system is working. If their customers can't commercialize the products that they're developing on the platform, there's no royalty revenues for Ginkgo. So that's very important. When we look at the types of projects that are working on, what we can see is that on the left-hand side, these are the sorts of projects that will probably yield royalties sooner than the categories on the right for regulatory reasons. What's important to note here is that Ginkgo is growing the number of projects in each segment, industry segment, over the past year. So they'll continue to grow those, and that's the pipeline that we can expect to pay royalties down the road. In the 10K, you can see they've segmented revenues by industry. This bump for consumer and technology, we assume, relates to the Kronos Group milestone payments of 12 million each for Q3 and Q4 2021. And we can watch this going forward to try and see where royalty revenues might be coming in or where they're experiencing success. Now, one other thing we noticed in the 10K that seemed quite surprising, I'll say, was that the company changed their vesting rules for stock-based compensation and realized 1.5 billion of compensation that was vested in 2021, and then there's another 2.2 billion over the next 1.6 years. So that's a total of 3.7 billion dollars in stock-based compensation for their employees. Seems like a large number. There's not a lot really to compare that against, and it's kind of a subjective comment to make, but that seems pretty big. Now, when you look at the two individuals that are leading the company, the chief executive officer and chief operating officer, this is where things seem a bit odd. So these individuals collectively took in $728 million in 2021 in total compensation, and most of that was from stock awards that you can see here. Now, the price of the stock has changed since then, so they used the price of the stock at the time the grants happened, but it's still a very significant chunk of change to be paying out to uh, the CEO and COO. We're always critical of people that talk smack about the high payments that senior executives get because they have a lot of responsibility, but this really pushes the boundaries of what I think normal expectations would be around what people at this level ought to be making, every year. And of course, they made sure to highlight that they hit all their KPIs for 2021. That's great. They exceeded their estimates on the SPAC deck. That was great. They took the company public. That's great, but seems quite high. So there's another 200 million shares available in their incentive plan, what they call the 2021 plan, to further incent employees. There was a comment in their year-end call. One analyst had said the stock-based compensation was a big number. It was the only real comment that was made regarding that. And he had asked about whether or not all this equity was already issued. And, he was more or less inquiring as to whether or not the share pool was expanding as a result, and it's not. But be that as it may, we should expect a lot from these individuals because they're getting compensated quite well. Looking at the valuation, a lot of people on our last piece that we talked about, Gingko, were asking, if our opinion had changed. So I think the last time that we looked, they had a market cap of around $18 billion, and that's now around 6.8 billion. Well, we can recalculate our valuation ratio using the updated revenue numbers. So this first item is Gingko with biosecurity removed. So we don't want biosecurity exposure. We just want Foundry exposure. So we're removing that element, which we will presume eventually dries up the pandemic pivot that they did. Although in their year-end report, at some point they talked about how they expect that segment to move into other areas. So we'll see how that goes. We're mainly interested in Foundry revenues. So if we remove the biosecurity revenues, we get a valuation ratio of 50. Well, we don't invest in anything with a valuation ratio over 40. And then if we remove related parties from Foundry, then we get a valuation of 72. So these numbers are a lot better than what they were before, but they're still reflecting an overvalued firm. So, two things can happen for this ratio to fall. Either the market cap falls or revenues rise. So when we calculate this valuation ratio using their Foundry estimates, the midpoint of their Foundry estimates for 2022 comes in around 172.5 million. Then it just comes under, it's actually 39. That's the valuation ratio. So, that would mean at the current valuation at the end of next year, provided they hit their targets, then this would be in range. That doesn't mean that it's fairly valued. It's simply a rule that we've set for ourselves to keep us from paying too much for stocks, and it's worked quite well. To be honest, that ratio could be lower than 40 and would have worked equally as well. A good, let's say, could have made it 30. But as we said before, that's just an arbitrary number that we set. It's not so important the value. It's important that you actually have a cutoff that you use so you don't overpay for stock. So to conclude, Ginkgo made great progress. They exceeded their SPAC targets. They grew third-party Foundry revenues. Things are looking good for next year. But as we said, they're still overvalued. We're happy to wait on the sidelines. We don't have any of this fear of missing out stuff. So we're just going to watch what the company does. We'll continue to cover them closely because there's a lot of reader interest, and we're expecting great things from the highly compensated team in 2022. So thank you very much for taking your time to watch this video. Make sure you subscribe. If you have any comments or questions, just put them on the video and we'll answer them. And make sure that you come back for more videos we'll be putting out on Gingko. Probably look at covering them again. And if a significant event doesn't happen at the end of next year. So thank you very much for your time.